investment in fixed income instruments, financial derivatives, and commodity markets in India. Do you know what a fixed income investment is? Fixed income is an investment approach focused on preservation of capital and income. Example: government and corporate bonds, CDs, money market funds, etc. It can offer many potential benefits such as diversification of stock market risk. Fixed income is broadly understood to carry lower risks than stocks. This is because fixed income assets are generally less sensitive to macroeconomic risks. Capital preservation. It means protecting the absolute value of your investment through assets that have a stated objective of return of principal. Hence, because fixed income typically carries less risk, these assets can be a good choice for investors who have less time to recoup losses. Income generation. Investors receive a fixed amount of income at regular intervals in the form of coupon payments. Total return. Some fixed income assets offer the potential to generate attractive returns. Investors can seek higher returns by assuming more credit risk or interest rate risk. Do you know the risks associated with fixed income? Interest rate risk. When interest rate rises, bond prices fall, meaning the bonds you hold lose value. Inflation risk. Bonds provide a fixed amount of income at regular intervals. But if the rate of inflation outpaces this fixed amount of income, the investor loses purchasing power. Credit risk. It is the possibility that an issuer could default on its debt obligation. If this happens, the investor may or may not receive the full value of their principal investment. Liquidity risk. It is the chance that an investor might want to sell a fixed income asset, but they are unable to find a buyer. Now, the question is, how can one invest in fixed income? Mutual funds and iShares ETFs are the major fixed income sources. Mutual funds actively manage bond strategies in the form of mutual funds can pursue the most attractive opportunities in fixed income markets while seeking above benchmark returns. With experts in every sector of the world's bond market, BlackRock combines global reach with local expertise to access opportunities wherever they reside. iShares ETFs, exchange traded funds, first appeal to equity investors, providing efficient access to the world stock market. Now, ETFs are transforming fixed income investing. Financial derivatives and commodity market in India. Financial derivatives are contracts whose value is derived from the underlying asset. Hedgers and speculators widely use these contracts to take advantage of market volatility. The buyer of the contract agrees to buy the asset at a specific price on a specific date. Similarly, the seller also enters into one such contract. The different types of derivatives include futures and options, forwards and swaps. What are derivatives? Derivatives means financial contracts that earn their value from a group of assets or underlying assets. Depending on the market condition, the value of derivatives keep on changing. The primary principle of entering into derivative contracts is to earn a large amount of profits by contemplating the underlying asset's value in the future. Imagine a businesswoman invested in an equity share and the market price of that equity share fluctuates up and down continuously. If the market falls, she may suffer a loss due to a stock value downfall. In this type of situation, she may enter into a derivative contract, either make profit by placing an exact bet or simply take a rest from herself from the losses that occurred in the stock market where the stock is being traded. There are four types of derivatives which are as follows. Forward contracts. It is an agreement formed between both parties to sell their assets on an agreed future date. Future contracts. It means an agreement made by the two parties to buy or sell an underlying instrument at a fixed price on a future date. Options contract. An option is a derivative contract that gives the buyer the right but not the obligation to buy or sell the underlying asset. It consists of two options, call option and put option. Call option means the buyer has all the rights to purchase an underlying asset at a fixed price while entering the contracts. Put option, where the buyer has all the right but not the obligation to sell an underlying asset at a fixed price while entering into the contract. Swap contracts. Swap contract means the agreement is done privately between both parties. The parties who enter into swap contracts agree to exchange their cash flow in the future as per the predetermined formula. What is a commodity trading market? It is a marketplace where you can buy or sell and trade in commodities. The commodity trading market can be both physical and virtual. There are four types of commodities which can be traded in commodity trading market: metals, energy, agriculture, livestock and meat. Where does commodity trading takes place in India? There are four major commodity trading exchanges in India: Multi Commodity Exchange of India, National Commodities and Derivatives Exchange Limited,